Why do we even have to use whole life insurance as the machine for the infinite banking concept? And that's where it gets really interesting. You see, whole life insurance, if designed properly, now let me preface that. The whole life insurance policy has to be specially designed and engineered. And that designed and engineered does a couple things. Number one, it makes it so that the policy has immediate cash value. And it also gives high early cash value to the policy. So if you're going to create a banking system, you need access to the money immediately in the first 30 days. And that designing and engineering of the policy allows us to do that. But it comes at a cost to the agent. The agent has to design the policy with a much lower death benefit, or they would use a term rider to supplement the death benefit, which in turn reduces the agent's commission by up to 60 to 90%. There's not a lot of agents that want to take a cut in pay of 60 to 90%. But once you understand that that's what's necessary, you understand that that's the only way it works. But there are different types of whole life insurance that you got to be aware of. And one of the big reasons I wanted to create this video is to explain the difference between a direct recognition and non-direct recognition insurance company. Because it does matter when you're using these policies for the infinite banking concept, whether it's direct recognition or non-direct recognition. So with that, let's dive in. So if you wanted to become your own banking system, well, you would need a whole life. And how it would work, you would specially design and engineer a whole life insurance policy so that it has high early cash value. And then you would take loans from the insurance company and you would use those to take back the banking functions in your life. In other words, you'd no longer use credit cards. You would pay the credit cards off and make payments back to your policy. You would use your policy and take loans from it to buy cars and make payments back to your policy. And this is where I really want to focus today's video on, the loans. Because there's a huge difference between the different insurance companies that we would use. Some of the insurance companies are what we call direct recognition. And the other insurance companies we use, the ones we favor, are called non-direct recognition. So in today's video, we're going to talk all about the difference between the direct recognition and non-direct recognition insurance companies. So the first thing, let's just get this out of the way. Let me give you the definition of a non-direct recognition. Here it is. Non-direct recognition refers to a feature where the insurance company does not directly recognize or adjust the policyholder's loan interest rate when determining the credit interest of the policy's cash value. So in other words, to simplify that, a non-direct recognition company, when you take a loan, the insurance company does not recognize the loan. So therefore, it does not adjust the interest or dividends that you're earning on the cash value, which, if you just heard me correctly, that would be favorable, right? All your money gets to earn interest and dividends while your money is used out there in the infinite banking concepts, the loan, in other words. So that's favorable. So now let me define direct recognition for you. Direct recognition is a strategy used by insurance companies to manage the loaned cash values of the life insurance policies. Unlike non-direct recognition, where the earnings rate remain unchanged regardless of the cash value being used as collateral for a loan. Direct recognition allows those rates to be either negatively or positively affected when the cash value is accessed. So plainly simple, when you take a loan from a direct recognition company, what happens is they recognize the loan, which means they have the ability to adjust your dividends down because you're only receiving a dividend on the remaining cash value, not the total cash value, because they recognize the loan that was being taken out and can subtract that and pay you a lower dividend. So before I go any further, what I'd like to do is I'd ask all of you to recognize something. I'd like you to recognize that it takes a lot of energy and effort to put these videos together every single day because we put one out every day. So could you do me a huge favor and click the subscribe button? That's my reward for the recognition that you're giving me. Now the second thing, there's a little bell up top. What I'd like you to do is I'd like you to smash that bell. And that will notify you every time I put new content out or when we go live, because we do a lot of lives on YouTube. But let's get back to direct versus non-direct. Now, let me give you my personal take on that. The only companies I like to use when we're building policies are non-direct recognition. Because the biggest thing that we know is that our clients, when they set up this policy, we're going to set it up for a specific problem that we're going to solve. And that problem is going to always involve taking a loan from the policy, usually immediately in the first 30 days, and having that money go to work for us a second time. So in a non-direct recognition, by doing that, when we take the loan, it doesn't affect anything. The insurance company simply doesn't recognize that there's a loan and continues to pay us uninterrupted compounding interest on all of our cash value. If we were to flip that and we were to do the exact same thing but from a direct recognition company, and let me just pause and transition. Why would we use a direct recognition company? Well, there is this one mutually owned insurance company that is direct recognition that a lot of the other folks out there use, and they use them because they illustrate really well. But they illustrate really well because the way they calculate their dividends in their illustrations never assumes a loan, and also the way they calculate their illustrations is different than the other carriers. So their illustrations can look better. So in the eye of the client, they're looking at numbers on a piece of paper and they think those numbers are exactly what's going to happen, but that may not be. Because if they use the policy and they take a loan, that insurance company is going to recognize the loan, they're going to adjust the dividend for the cash value being taken out, and now all of a sudden your uninterrupted compounding interest is compounding at a lower amount. So therefore, over time, you will have less cash value, you will have less growth because the loans actually hurt the policy. So the only time that doesn't matter whether it's direct versus non-direct is if we get a client that just wants to use the policy as a savings vehicle. They want to put money in the policy because number one, they want the death benefit and they want to earn a little bit more interest and dividends than they can earn in a bank. And some of the other features like tax-free growth of the cash value and protection against judgments and liens in most states. So those would be some of the reasons why the client would do that and just put money in and save it there. But if they take loans, direct recognition all of a sudden becomes a hindrance on their future growth. So if you had a non-direct recognition company and you took the loan to have it go pay off debts, buy cars, or whatever you're going to do with it, then your money, when it goes out, all of your cash value is still earning the same interest and dividends as it was if it was just sitting in there. But that isn't the case with the direct recognition. There's a big difference when you go out 10, 15, 20 years. But if you're just looking at direct versus non-direct in the first 5 years, it's a very small difference. Actually, one that would be negligible to even really consider. But over a long period of time, that uninterrupted compounding does make a big difference. And the amount that it's compounding on, well, that's where the difference comes in. And the advantage comes in for non-direct recognition companies. Not long ago, I did a webinar, a wealth webinar, and I did that. A stock-owned company prioritizes shareholder returns, which can sometimes lead to decisions that prioritize profits over policyholder benefits such as higher premiums or lower dividends. So in other words, a stock-owned company is going to prioritize some stockholder who you don't know, you don't care about, somebody that doesn't give a shit about you, and all they care about is more money. Showing the difference over a 5-year period of time for a client who had a direct recognition company. He had taken loans every single year from his policy. And then what I did is I showed, okay, here's how much cash value he had after 5 years. But then I went back to the original illustration where there was no loans taken, and I said, here's how much cash value he should have had. Now there's a couple factors in there, like dividends have changed. They pay more in dividends now than they did in the original one. But nonetheless, even though dividends had gone up with the policy he was taking loans on, the original illustration, which showed dividends where they were back then, had more cash value. So the reason for that is, well, he was earning dividends and interest on the full cash value in the original illustration. In the illustration that I printed, which is called an in-force illustration, it showed him taking loans every year for 5 years. Therefore, the direct recognition of the loans being taken out resulted in him earning a little bit less dividend. Even though it was a higher dividend payout, he earned less dividends because he was only earning dividends on the remaining amount. Well, the end result is he had a couple thousand less in cash value than he would have had he just left the cash value in there. Now, the thing I'm not accounting for there is when he took loans, he's very good about using the infinite banking concept. He sent that money out to work and made great returns on that. So that far outweighed the difference in dividends that he would have received by just leaving the money in there. But nonetheless, would that client have been better off doing a policy with a non-direct recognition company? The answer would be yes, of course. He would have had a little bit more money in the tune of a few $1,000s in that example that I gave. So when you're looking at setting up your policy, and if you're not doing it with us and we're not setting it up, make sure you ask this question. Is the company you're putting me with a non-direct recognition company? And if the answer is no, ask them to look at a non-direct recognition company, because it will make a difference if and only if you plan on taking loans out. So folks, I've covered this topic a few different ways and in a few other videos. So by all means, go into my archive of over 1,000 YouTube videos and search direct recognition or non-direct and watch the other videos, because on some of the other videos I've given actual numbers and given you actual case study examples showing that. Today I just wanted to kind of hit it again because we are starting to hear about this a lot more. But more specifically, we have competitors that are using just direct recognition companies, and they're doing it because they can illustrate them and show a higher cash value. But the illustration does not always tell the whole story, because when you're doing the infinite banking concept, the illustration only shows you how the policy grows without loans being taken out. So the time when you're going to find out that's problematic is when it's too late and when you have loans, and then you go back and you look at your original illustration and you look at your in-force illustration like I just mentioned, you're going to notice the difference then, but there's nothing you can do about it at that point. So in conclusion, I think the most important thing is just be knowledgeable. When you go into this, just knowing what you're doing, at least at a surface level, knowing the difference between direct recognition and non-direct recognition, knowing the difference between whole life and IUL and why IUL will never work for the infinite banking concept, but also knowing which companies and which plan designs work best for your individual needs and goals. Like I had mentioned, a direct recognition company might actually be better for somebody if they don't plan on taking loans from the policy. But if they plan on taking loans for the infinite banking concept, well, I have a hard time saying that a direct recognition company would be better even though it shows a higher cash value in the illustration, because I know, because I've seen it, that isn't going to be the case when they start taking the loans and using the money to implement the infinite banking concept. So this is just little stuff, not everything that you need to fully articulate and understand, but at least know from a surface level to ask the question. Is the agent putting you with the right company, and does it solve your problem the best? Thanks for joining me. We'll see you on the next one.